Hey, Steve. So we just wrapped up our 73rd consecutive ISG Index call. And as you know, Steve, we had over 2,000 service providers and enterprise technology leaders and equity analysts and media on the call. So just a fantastic turnout on the call. And it really shows how much interest there is in the IT and business services industry. So let's jump into the results. So as we talked about on the call, the combined market had its best quarter ever in Q4. ACV in the quarter grew 13% year over year. And on a full year basis, the combined market was up almost 7%. So Steve, my question here is, what's your take on the overall health of the IT and business services industry?
Well, great. Well, first of all, Stanton, Happy New Year to you, and it's great seeing you again. Hope everybody's safe and enjoyed the holiday season. So the overall performance was positive news for the industry. As we've discussed, hyperscalers really led the growth, which highlighted the turbocharging of public cloud adoption really across all regions. But managed services also pulled in impressive numbers on a quarter-over-quarter basis, up 8%, and the strongest quarter since Q2 2018. It also aligned well with the 5-year average, actually up a little bit, which really indicates the market is recovering well and that enterprise IT spend is returning to pre-pandemic levels. My only concern, though, is the heavy concentration of mega deals in EMEA this quarter, which, if we normalized it, would indicate a slower recovery and continued weakness in the managed services space. Overall, though, I'm pretty optimistic, though, since our pipeline indicates continued strong growth into the first half of 2021.
Okay, Steve, so now let's talk about our as a service basket, which, as you know, covers cloud and co-location vendors. So it was up 24% in Q4 and 17% on a full year basis. So as we've talked about, as a service is now 56% of the combined market. So my question, Steve, is do you think we're going to continue to see as a service be a bigger and bigger share of this combined market?
The easy answer, Stanton, is absolutely yes. I think we'll continue to see the cloud market grow. The as a service includes infrastructure and SaaS grow. But quite frankly, I think we're going to continue to see the overall market increase. And let me give you some examples. The managed services market generated just under 7 billion of ACV quarterly since 2017, or about 27 billion of ACV per year. The combined market, though, has grown from 42 billion 4 years ago to almost 60 billion in ACV in 2020. You look at this sort of 9.5% compound annual growth rate, or almost 42% during that period. This growth is all led by the as a service firms, which is fueling a broader ecosystem of capabilities and strong M&A, environment. Service providers, though, have also managed to grow during this period through partnerships and alliance with the cloud providers and expanding their offerings into product engineering. I mean, you got to admit, adding 18 billion of additional ACV over the last 4 years to a big pie is great for the entire market.
So Steve, let's talk about ITO. It actually had its best year ever at 21.4 billion, and ITO deal volume was up almost 10% year over year. But when you look under the covers, you can actually see it's applications driving this growth, not infrastructure. ADM ACV was up 2% for the year, but infrastructure only ACV was actually down 20% year over year. So Steve, my question is, do you think this trend of apps in front of infrastructure is going to continue this year?
Yeah, I do think it'll continue. I think, unfortunately, that apps are really going to be the predominant driver of the market going forward. And when we think about the index, we really track IT spend in multiple categories: apps, infrastructure only, network, and full ITO. Apps and full ITO, which was heavily weighted with the applications and workplace of the future deals, which are like EUC, collaboration, et cetera, were up with lots of deal activity in 2020. Infrastructure deals, though, primarily associated with data center outsourcing, as you mentioned, was down 20% year over year and down almost 25% for the 5-year average. We've seen a decline of an average ACV of at least 1.5 billion of ACV quarterly since 2014 to barely a billion of ACV per quarter now. It's also clear that we have a very clear pattern between data center spend and cloud spend. I think we'll see this trend accelerate as public clouds adopted. The good news is, though, that service providers are creating new offerings to compete, especially with cloud management platforms and managing multi-cloud environments. Software tools are making it easier to do this, but that's also going to continue to erode the traditional data center outsourcing space. And I've put a chart together which will sort of help show that spend. If you just look sort of at the quarter from Q1 14 to Q1 20, you can really see sort of the decline in the infrastructures, or the decline in the managed services space, and really that acceleration that I talked to in the infrastructure as a service space, and where that crossover took hold, and how we continue to see that market evolve.
BPO ACV was down almost 23% on a year-over-year basis. So Steve, we've talked a lot about the impact of the pandemic on the BPO market, but let's talk more specifically about why this happened and what we think our outlook is for this year for BPO.
So the crazy thing about BPO, Stanton, is it was a great story in 2020 if you take out facilities management. So between the collapse of WeWorks and the pandemic, which led to the closure of almost all office space, the facilities management space was down over 1.5 billion in ACV this year. So that's massive. And that really accounted for all of the weakness in the BPO market. F&A and HR deals were both up significantly. Both were up over 30% from their 5-year averages. And it really seems to me that the investments in analytics and platforms are really paying off for service providers in this space. For example, there was over 650 million of ACV awarded in the F&A space this year, on a similar number of deals as what we've seen on a quarterly basis. And that ACV is the highest ACV since we've seen since 2012. Traditional HR outsourcing remained weak, but deals with an HR platform and analytics drove higher ACV deals per quarter. So, there's a great underlying story on the BPO side about some real strength in that market once you get beyond facilities management and a little bit of the contact center.
So Steve, infrastructure as a service was almost the complete opposite story from BPO. It was up almost 23% year over year as companies continue their march to the cloud and start to take advantage of a lot of these higher margin services like analytics and machine learning. So Steve, as you know, we get this question a lot on the Index call. Let's talk about the relationship between managed services and infrastructure as a service, and what are the opportunities for providers here?
Yeah, as we discussed earlier, the transition to the cloud is crystal clear. The growth rates are going to continue to be in the 20% plus range, even though some analysts are arguing that the rate of growth is slowing. Service providers, though, that partner with cloud providers have plenty of runway in the short term. Let's call the short term sort of 3+ years, really helping organizations transform their app portfolio to be cloud native. There's also opportunities to help enterprises manage cloud sprawl, security, and multi-cloud solutions. And I expect through the real transition for SPs will be with IoT and IT/OT integration as your sort of traditional IT or ITSM services and infrastructure management tools are really applied to the shop floor, engineering, and other enterprise disciplines.
All right, Steve, so let's wrap up with our forecast for the year. We're forecasting a 3% growth number for managed services and 20% growth in as a service. So my question is, what are the factors that we think could change those numbers either to the upside or the downside this year?
Yeah, it all starts with the pandemic, Stanton. So let me take the downside first. There is tremendous optimism with the vaccine, but the fact is there are still several new variants, and we're still seeing almost 500,000 new cases worldwide on a daily basis. Most of Europe is in lockdown, and the hardest hit sectors still haven't recovered. It's easy to imagine further delays with administering the vaccine, which would keep large economies in lockdown. We still have supply chain issues. We still have issues with shipping containers, lots of headwinds, if you will, all associated with the pandemic that will impact Q1. On the upside, organizations have learned to work virtually, and after tightening their wallet over the last 3 quarters, are ready to reignite their transformation programs. Our pipeline has some good signs of larger deals that could also come to fruition, so that's good news. Lastly, there are several large breakups and M&A deals on the horizon that may slow down decision-making. IBM spinning off their traditional outsourcing business to a new co. Atos and DXC are discussing a merger. And these firms remain very influential part of the overall market. So any delayed decision-making would have an impact on the overall growth. I do think we're being conservative with the forecast though. So if we start off with a strong Q1, let's put it sort of in the 6.8 billion of ACV range, I think I'll be much more optimistic about a faster recovery as we go forward. For more details, please visit the ISG Index page on our website, www.isg-1.com.